Chapter 12 of financial accounting, we talk about the presentation of the statement of cash flows and the analysis of that statement. So it's definitely very useful. It's the only statement, when you're comparing it to the income statement and the balance sheet, that really shows how the company is coming up with cash and using cash. Your income statement and your balance sheet, we use accrual-based accounting. So some of those entries that go into it are not cash-based. This is all truly cash-based and cash flows. So, you can look at it by category and see where their money is coming from. You can see if they have the ability to pay their debt as it comes due or pay dividends. And again, there's that difference between net income and net cash because, again, with generally accepted accounting principles and all of our accrual entries, sometimes those can be quite different. And then you can clearly identify where they're investing their cash and how they are financing those transactions. So we have these three activities that the statement of cash flow is broken up into. So we have operating income, we have operating activities, which basically start with our net income and deal with all of our, the things that we're doing to make money. So it's not all of the income statement items. We're going to see that it deals with our current assets and our current liabilities as well, but it's the current assets and the current liabilities that we are using every day to generate our sales, bill our customers, pay for our inventory, the stuff we're really doing to operate our business. Investing is really when we're taking our money that we do have available and investing back in ourselves. So maybe we're going out and we're buying new property, plant, and equipment. We're acquiring a competitor to get bigger. I mean, it could be that we are investing money like actually in the stock market, but it's more than likely the long-term assets that we're investing our money into. And then the financing is saying, well, how are we paying for these long-term assets? Are we getting loans? Are we increasing our long-term liabilities? Are we issuing bonds? Are we selling shares of stock? And where's that money coming from? Excuse me. And our cash inflows, so again, we'll look at the different line items and say, some of them will be positive, which is money coming in, and some of them will be outflows, which is money going out. So obviously money coming in is selling our goods or services. We could also even sell our assets to get money. Our outflows when we pay for our inventory, we pay our employees for wages, we pay taxes, we pay interest, we pay utilities and all that type of stuff. So again, the inflows could also be, like I said, a sale of property, plant, and equipment. So say we have an old truck that we're selling, or we have an old piece of equipment we no longer use. If we sell that and we get cash, that would be a cash inflow. If we were investing in the stock market and we had bond investment or stock investments and we decided to sell those to get cash, that would be cash inflow from investments. And then if we had loans that we had loaned other companies money and they were paying us back, again, that would be another type of an investment. What outflows come in our investments and our long-term assets are, we could be purchasing property, plant, and equipment, so that'd be a use of our cash. We again could invest in the stock market or the bond market, and again, that would be a use of our cash. And then if we could make those loans. Then our final category, the financing activities, what are inflows from that? We could sell common stock or preferred stock and we receive the cash, so that's money coming in. We could sell bonds and that's money coming in. Outflows are when we pay our dividends, that would be money going out. And then if we paid down our debt or we purchased treasury stock, we purchased our stock back. There can definitely be non-cash activities that occur within a company. And if we have those non-cash activities, they don't end up on our cash flow statement. Obviously, it has to be a cash transaction. But some of them can still be material, and the stockholders do want to know about it. So those are going to be in a separate schedule at the bottom of the statement, or just in the notes to the financial statements to say, hey, we we converted so many bondholders into shares of common stock, or we gave common stock to purchase land, or things like that. The format of our cash flow statement is we're going to focus on the indirect method, where we've got our operating activities, our investing activities, and our financing activities. And the statement of cash flow pretty much would look like this. So we're going to list out all of the different operating activities, and this is normally the biggest section. Then we'll list out all the investing activities again separately, and the financing activities separately. We'll sum all of those three sections up to say, do we have a net increase or decrease in cash? We will add that to our cash at the beginning of the period to have what our ending cash would be. So again, what was our beginning cash, add our change in cash to give us our ending cash. And then we would list out any non-cash activities at the bottom. So then you think, okay, well, how do we get all this information? So a lot of it comes from the balance sheet, but when it comes from the balance sheet, you're looking at your change. So you need to go from January 1st to December 31st. So what happened to my accounts receivable at the beginning of the year to the end of the year? How did it change? What happened to my inventory? What was at the beginning of the year? What was at the end of the year? How did it change? And we go through all of those balance sheet accounts just like that. What is that change from beginning to ending? The current income statement we will use because we will pick out the net income from that statement. We will pick out depreciation expense from that statement. And then sometimes there's additional information that is given to us, and that will factor in as well. So here we have, again, our first step is preparing the operating activities. And I feel like it's the hardest step, to be honest. It starts with our net income, but then we have to go through and calculate all those changes in the balance sheet accounts. And what goes into the operating section is our changes in our current assets and our changes in our current liabilities. So then that's what this is saying. So we're analyzing all those changes. And sometimes that's where it gets a little bit confusing. But then we'll also take it down to the next level to say, okay, well, as we look at our changes in our assets and our liabilities, if they're non-current, then that means they are in our like property, plant, and equipment, or in our long-term debt. If they're in our property, plant, and equipment, or our intangible assets or other long-term assets, all those changes will go in our investing section. If they're in our debt or our bonds payable or in our equity section of our balance sheet, those will be in the financing section. Then we go through and we look at what is our change in our cash. So we've calculated our operating activities, our financing activities, and our investing activities, and we subtotal those. And we actually look at our balance sheet and say, well, is that the change in cash? Because it should be. So our beginning cash to our ending cash, subtract those to get to that change, and that should be your change in cash on your cash flow statement. So that's nice because there's always that double check. That way you know if your cash flow statement is working out or not. Companies primarily do the indirect method, so that's what we're going to focus on. It's easier and less work to prepare, and then it focuses on the differences between net income and cash flow. So here shows you an example. So again, we've got our balance sheet. So we've got last year's year-ending balance and this year's. So again, the last year's year-ending would be our beginning of the year balance. So we subtract those to figure out what's our difference. So cash had a $22,000 increase. That $22,000 should be the change in cash on our cash flow statement. Our accounts receivable decreased $10,000. So that decrease of $10,000, we should see it in the operating section of our cash flow statement. Same with inventory and prepaid expenses. Now, when we move down to our property, plant, and equipment, these changes, other than depreciation, should end up in our financing section. Depreciation is in our operating section. Then we go down to our current liabilities. All of those should be in our operating section. And then our long-term debt and our equity should all be in our financing section. So here we have the income statement. So again, the net income is how we start our operating section of our cash flow statement. And then the depreciation expense is something that we add back. And then also the loss on the sale, we're going to add back. So again, they give us a list of some of the important items, but we have depreciation expense. We have how we came up with that loss on the sale of the asset. They've issued some long-term bonds. They bought a building for cash. They bought equipment for cash. They issued stock for cash, and they paid a cash dividend. So then now as we look through those, we go through our different sections. We always start with our net income in the operating section. We add back our non-cash expenses, which are depreciation, amortization, or depletion. We subtract any gains on sales or add back any losses on sales of assets because that cash is going to go down in our investing section. This is something that hits the income statement, so it's deducted or added into our net income, so we have to adjust that, but we want the cash to go into the right section. And then we go through all of our current assets and our current liabilities and factor in those changes. So here we have our net income. We add back our depreciation expense. Then we're going to see here, then we add back that loss on the disposal of the assets. Okay, then we go through and say, okay, our accounts receivable has changed by $10,000, and our inventory has changed, and our prepaid expenses have changed. So all of those are going to come in. So this is where it gets a little tricky. And in your notes, you've got some general rules that you'll want to kind of memorize or know those. But if our accounts receivable goes down, that means we collected the cash. So then our cash goes up. If our inventory goes up, that means we bought more. So our cash goes down. If our prepaid expenses goes up, it means we gave money to insurance or rent or whatever, but we haven't charged it to an expense yet, so our cash goes down. So you got to kind of logic through some of those, but that's where it does get a little bit tricky. Then we'll subtotal all of those and add that to our net income, so our cash provided by operating activities is $158,000. Then we have our changes in our liabilities. So again, if our accounts payable goes up, it means that we have charged more things to expense that we haven't paid yet. So then we need to add those back to our net income because we deducted them from net income, but we haven't actually paid them in cash yet. If it goes the other way, if they decrease, it means that we're going to take it out of our cash because we had already recorded it in our net income in a prior year or prior period, and now we're paying it. So an increase in accounts payable is an increase in our cash. A decrease in those taxes payable that were recorded in another payable is a decrease to our cash. So then now we have our total operating activities. So we had our net income, add back our non-cash expenses, add back our losses or subtract out our gains, and then go through all of our changes in current assets and our current liabilities. And then here again are the general rules. So that's kind of what I was talking about. These are also in your notes. But so kind of study that or write those down and have those in front of you. But if you can kind of logic through them, that helps as well. If not, just go back to this rule. All right, then we get into our investing and our financing. So we've purchased land for We've purchased land for $110,000 by issuing bonds. So in this case, there is no cash. So that's a significant non-cash transaction, and it's going to go down at the bottom of the cash flow statement. Okay, now this one, we acquired an office building for cash. So that is going to go in our investing section. So we've got our Cash flow from investing, we purchased a building for $120,000. And then we purchased equipment for $25,000. So that's also going to go into our investing section. And then that sale, the key to the sale is we already dealt with this loss up in the operating section. We added it back. Now we're going to deal with the cash. So then you can see the cash is coming in because we sold the equipment and we received the cash. So that increases our investing activity. Then we issued shares of common stock. So we received cash when we did that. So that is going to show up on our cash flow statement as cash coming in. Okay, then we paid dividends. So we had net income, which we've already accounted for in our operating section, but we paid dividends of $29,000. So we are going to show those dividends paid again on our cash flow statement as a cash out in the financing section. So then here we kind of have it in good form. Like I said, the operating section is normally the biggest. Then we have our investing section where we dealt with our long-term assets. And then we have our financing section where we sold some shares of stock and we paid dividends. Then we net these three categories up. So the 172,000 minus the 141,000 minus the 9,000 gives us a $22,000 increase in cash. We have cash at the beginning of the period and cash at the end of the period, and these should all tie to our balance sheet. So then if we look back over here, it does. So our balance sheet shows a $22,000 increase in cash, our end of the year balance, and our beginning of the year balance. So then when we analyze that, the textbook shows us this formula, this free cash flow formula. So you take your net cash provided by operating activities minus your capital expenditures minus your dividends. And if you have a positive number, that means you have enough cash coming in from your sales to cover all of your investing activities. Which is great. If it's negative, it means the company needs to borrow some money. They need to do some financing activities or sell some shares of stock. Okay, so here again, they show us the net cash from our operating activities minus our capital expenditures minus our dividends paid. So we have a free cash flow of $50,339 positive. So that's a good cash flow. Okay, so that is it. So the cash flow statement is kind of complex, but if you can kind of work through those different steps, that should help you understand it.